All right, so I am going to give credit where credit is due. I have a very nice gentleman who sits next to me in my season seats named James, and I told him what I did, and he was very interested in seeing it and learning it. And so he started listening to the show, and he's like, I am just so lost. I said, okay, well, give me a list of the things that are troubling you, that you're not so sure about. And I'll try and put all of that into a beginner workshop. All right, so let's go ahead and get started. All right, so what I'm going to cover, price bars and time frames, the basics on a chart. What are you looking at? I'll look at moving averages, just a quick explanation of those and how they're helpful. One of the important parts of technical analysis, of course, drawing support, resistance lines, and then also trend lines. Me, who's crazy about chart patterns, I will show you some of the basics. And then at the end, I'll just cover a few of the basic indicators. All right, so what's the difference anyway between technical analysis and fundamental analysis? We always talk about the two of them as separate entities, and they really are separate, but there are lots of overlap between technical and fundamental analysis. So really, technical analysis, this is why the math majors, those of us who like the math and the charts and the visuals, it's really you're forecasting price movements based on just what you're seeing in a chart from what past price movements are. So if you want to say a technical purist, you would say that everything is baked into the chart, everything. But a lot of us, I am on that side to some degree, but there also is important fundamental analysis that I do include. And that is, you have to look at what are the underlying forces. So we want to know what the Fed's doing. We want to know which sectors are doing well. We want to know what industry groups are doing well. And all of that really does come under the umbrella of fundamental analysis. So here are a few presentations of price. Basically, when you look at an OHLC bar, the one on the left, well, first of all, that's the low for the day, and this is the high for the day. And then the open is on the left side of that vertical, and the close is on the right. And so we can look at the difference between the open and close on this. We can also see, obviously, what the intraday high and lows are. There are various ways you can plot these on your chart. You can set it up so you get red ones when the close is lower the next day. Various ways to do that. And of course, there's the solid line chart, but most of us don't use that because we want that extra information that you can get from the bars and the candlesticks. I am not going to get way into candlesticks at all. I don't follow them. They're very short-term chart patterns, really to a day or two, depending. Basically they tell you about what to expect like the next day. So they're like a really fast chart pattern. And while I think those are great, my trading style, I just don't need to have a candlestick because everything is in the OHLC bar for me, because I don't need to know exactly what happened versus the next day. And here you can see how the candles are set up in basic language, just like the OHLC bar. You've got the high, of course, at the top of the wick, and then on the bottom here, you have the low, obviously for the intraday high and low. Then you have your open and close, just like we did here. Only with the candlestick, you make it a box, you make it a candle. The difference between whether it's black, red, hollow, and all of that, I've put that on here just so you can, it's just basically a matter of, okay, where's the close to the prior close, where's the close to the open, and that sort of thing. I don't want to get into it because I have so much more to cover, but you can find all of this in chart school. And I mean, all of this. I actually just took these charts right out of chart school. So then there are the time frames. Everybody's like, well, what does long-term mean? What does actually short-term mean? Well, I'll be honest, it does mean different things to different analysts. But typically, we all can agree that long-term time frame, you typically want to look at a monthly or even an annual chart. Intermediate term, you're looking more at those weekly charts. Short term, daily charts. Ultra short term, to me, day trader, that sort of thing, if you're really trading during the day. Hourly, and of course minute charts. So typically I stay in the daily charts. However, I find intermediate term information on the daily charts. So I consider daily charts useful for both. And as far as long term and intermediate term, of course, I do think of the weekly charts as intermediate term, but sometimes the chart patterns and the trends on those weekly charts really translate also to the monthly chart, meaning it's also a long-term presentation for you to look at. All right, so let's go ahead. I'm going to look at a few charts for you here, just so we can get through there. All right, so what I'm first going to talk about is support and resistance. And, you know, for a lot of us, we think of it as just so basic and, you know, it's second nature. And it really isn't that hard to come up with. You know, really, when it comes to trend lines and support and resistance, you want to get as many touches on the line. So let's go ahead. I'm going to take it to an annotation tool. And we're going to determine where our price support and resistance are on this chart. The excellent tool for this is using that auto support and resistance line, because it gives you that long, it tells you when the price is above it, price is below it. Let's make it big and thick so we can see it better. There we go. So you can see when you use that auto support, you can take a peek here. There's little red bars in here. That means the price, the close was below it, that support line. So if you can use it, actually use it and drag it to the point where you're not really seeing any of those little red lines. So to me, in this case, I would be looking at my price support at 46.50. And why would that be? Well, number one, I find that price support and resistance typically land on those, I don't know if I want to say even numbers, but I guess so. Usually you're going to have that, you know, like in this case, we are doing it in terms of 50 cents on each one. Typically people have a memory, like a psychology about their trades, because you think about, well, if it gets to 50, I'm going to sell it. I bought it at 45. So you're thinking about that. You remember that. And all of the investors also remember that. And so that's where a lot of times you're going to see a consensus of price support on these lines here on the horizontals that usually match up with like an even number. So in this case, the support level I figure is 46.50. That touches here. These two October lows it matches. It touches this low from back in August. And if you come back here, looks like it even matches a gap that's coming in over here. Now where's your resistance? So that's the support. That's where you want price to stop and then bounce. Well, that didn't happen yesterday, nor is it happening today. That's a problem. You know, you want to know that price support has been broken. So now the people who had this 46.50 in mind now have gotten all the way down to 45.50, and now that's when you're going to start to see some more selling. And typically that's why we look at the support lines, because when it's broken, typically you're going to see, of course, a continuation to the downside when you break down on that price support. So this one I would say is short-term to intermediate term price support line. Now, where do we figure the resistance is? Well, again, I look at those areas where it's usually an even number, or I look where the price tops are. The easy one, of course, would be where your highest one is on the chart, the highest level. And that's, you know, typically an easy way to come up with resistance. But let's face it, that's a long way up. So where else can I look for a possible price resistance here? I think there's a few of them. First, I would look at this level here, because I can see twice that was really a stopping point back in the summer in July and August. So I'm going to just draw that in based on just those. And then I'm going to look at where that comes up. All right. I think that's a pretty decent resistance line. It comes up, you can see it actually matches up with this gap. All right. And gaps are points in time where there is no trading activity within that price range. So you'll get, for example, an intraday move. It'll open much higher, enough higher that it's higher than the previous intraday high. And so you'll get these gaps in trading. And you can generally find support and resistance at those gaps. We always talk about gap support and gap resistance. So in this case, I think you can use this as a shorter term resistance line. You've got a touch back here in October. You've got these two touches back here. You could even think of it as a zone. A lot of times I will make a support and resistance zone. I'll make it more opaque. And you can do it that way, or if you just want to draw like a rectangle to give you that zone of support and resistance, there's a zone, because that matches up with this top, it's matching up with this top. So you know that in this zone likely is going to be some resistance on price. And it looks like today we got to that intraday high, didn't quite make it to 48.50. So now we're starting to head back down and below this support level, and that's not good news. Because now I want to show you a few trend lines. Actually, I'm going to take this to a longer term chart because I think that'll be more interesting. All right, so let's go to our regular market watchers chart, chart style. All right, and I've got too many indicators in here, so we'll take some of those off. But typically I'll go through those indicators, the basics that I like to use, just so you know. Okay, so we'll just take those two out. That'll give us a bigger price window. All right, so what about trend lines? And actually, now that we have a longer term picture here, I'll look at those support and resistance lines one more time. Okay, so we are going to do the auto support and resistance. I think I had what, 48.50 was the area, that zone. Yeah, I mean, it matches this low here, these two lows in the zone, but I would be more interested in the fact that this is where it stopped, like we were seeing on that previous chart, as possible resistance. And again, there is that gap. Move it up to that intraday low for that gap. And that matches up nicely with this gap, doesn't it? You'll find that, like I said, that'll happen just because it's not like muscle memory, but it's a psychological trading memory. And there's 46.50 was the other one I was looking at from these lows. And that actually comes pretty close to this high. It's close to this low. We got a breakdown. It was support previously back here in the end of 2017. So really that's how you're going to find your support and resistance lines. And according to Greg Morris, those are the only lines on a chart that matter. I understand what he's saying, because trading wise, that it really is where the rubber meets the road, I guess. The trend lines really are there for identifying what the trend actually is. And when you do that, you only will draw declining tops or rising bottoms. And why is that? Well, that's how you're going to really see where the trend is going, where you're, if you want to look at it as where the price trend could be broken, like a sort of like a support being broken. So I just start looking at obviously where the trend is. So right here, I can just see that's a short-term trend to the downside. So I'm just going to start drawing from these tops, declining tops. All righty, let's make this darker. All right, so there is a declining tops trend line. The intraday high today hasn't actually gotten up to it. So, you know, sometimes that will happen, sometimes it will not. For me, when I see price get almost up to a trend line and then fail, I find that a little bit more bearish, because it didn't even get up to test the top of that declining trend. And then we want to, so why do we only do declining tops and not declining bottoms? Well, we do, of course, when we make channels. But how is this really helpful? Think about it. We're going down, we're getting further and lower and lower. And this trend line can go forever. It's not telling us anything. It's not telling us about the trend. What's telling us where we want is breakouts, breakdowns. We're never really going to get a quote unquote breakdown out of this, you know, declining bottoms trend line. So you want to see, think about it. We've got a declining trend. What do we want to see happen? We want it to change into a rising trend. And how does that happen? You go with you get a breakout on the upside, and that's telling you the trend is changing. This won't tell you that if you do declining bottoms. However, we can cheat a little bit here. When you're drawing trend channels, and this is the easiest way, is you select it and you hold down, I know it's on the Apple, it's the Command key. I'm not sure what it is on PC, but you select it and then you hold down that key, and then it'll bring you the same line at the same angle, and then you can see if there's a trend channel going on here. I don't see one. I suppose if you wanted to make that one, I wouldn't, just because it's just not, you've got too many breakdowns below this, this channel here. So I wouldn't look at this as a trading channel. So let's go ahead and take that one out. So declining tops, the other one, of course, is rising bottoms. And again, you're measuring a trend that's moving upward. And you can't measure that with rising tops. I mean, you just, it's going to be, there's no way, again, to really see the breakdown of that rising trend until it goes down below, when it breaks down below that rising trend. So that's what we would look for. And this one in particular was pretty easy to spot. We've got these rising bottoms, and I will go ahead and let's see if this is a trend channel. I think it might be right there. It touches these two tops. So you have a rising trend. Of course, it's in a very wide channel, meaning you could still experience a lot of volatility even if you stay in that rising trend. All right, so those are trend lines. Let's go ahead and we're going to move on and talk about moving averages. So there are three types. I've done a bunch of these workshops, and I've done one on moving averages. I've done one on volume. I've done a lot of them. So I kind of pulled from all of them. So it might feel a little bit disjointed, but if you want to learn more about any of these concepts, you'll want to go try and find those workshops. All right, so there's three types of moving averages, basically: your simple moving average, your exponential, and a weighted moving average. Depending on what you want to see, that helps you determine which one you want to use. The simple moving average, of course, is just what you learned in school. Take all of the members, add them together, and then the number of them, you divide it by. The exponential moving average is a little different because you're going to start with a simple moving average, and then you calculate a multiplier. I'm not going to go through this formula. It is in chart school. And then from that weighted multiplier, you can put that's how you would create the EMA using that weight. And it's typically based on, of course, the time frame. Is it a 20-day EMA? Then your weight multiplier is going to have to do with 20 days. The weighted moving average, and not many people do these, but you can weight them in different ways. So, for example, a volume weighted moving average is going to take the volume into account when it's calculating that average. Not typically what we see. Triangular, you're gonna put more weight on the middle data. With the EMAs, you're concentrating more on what the information is in the shorter term. You want to know what is happening on your average. You want to put more weight on the front, on the I guess you could call it the back end of the data, the front end, because you want to know more about, with your averages, you want it to react more quickly with price. So you're going to see a difference in the simple and exponential. For decision point, we use exponential moving averages, mainly because we do want to concentrate a little bit more on the recent data, because we use our EMAs for our trend model signals. And that's basically just crossovers of these moving averages. So again, a lot of people use simple moving averages. I know Mary Ellen prefers those because that's typically what your big money managers are watching. And so she likes to watch those. Again, I use the others because it fits with my signals for decision point. All right, let's see. So we've looked at the trend lines. I didn't show you there is also an interior trend line that you can do. And let's see, we'll make this really big and we're going to make it red. An interior one is if you're just like, remember we couldn't make a trend channel over here. But what we could do is have an interior trend line drawn kind of through the middle of what's going on here. And that just tells me that there is a declining trend. You know, a lot of people will draw these. I don't use them very often at all, but you can draw those in there if you're just wondering, you know, if you want to look at just the trend in general and the angle, because maybe it's a little different than those tops. Because like right here, I would say this is more of the angle of that trend right in through here. So the declining tops don't really help us out there. All right, and we looked at trend channels and we looked at support and resistance. So now we're going to go and look at bullish chart patterns. We're going to move into the chart pattern arena. And again, I love these. I could spend 2 hours on chart patterns, probably more, because I just love them. We'll go over the ascending and symmetrical triangle. That is a bullish chart pattern. We'll be going over a bull flag, which is a bullish chart pattern, a descending wedge, and double triple bottoms. The rectangle also can be considered that. Like I said, I did a trading chart patterns workshop on Market Watchers Live. It was July 3rd of this year. So if you go back there, you can see that that video of my chart patterns. So, and then there's the bearish ones. And I know this is pretty much fire hose. Descending triangles, rising wedges, a bear flag, double and triple tops, head and shoulders. That was what somebody asked me specifically about, and the bear flag. So those are the chart patterns I want to look at right now. And I actually have some of those charts from a previous workshop that I did. So I have all of these different kinds in this chart list. I suppose I hate to offer it up because I know what happened to Tom when he offered his up, but I could certainly share this chart list with you, but you would have to send me an email so I can send it to you. Okay, where did my cursor go? That's weird. All right, so let's go ahead and I'm going to look at just a few of these because we just don't have. I'm going to concentrate. A lot of the ones we see typically are these flags. So we're going to look at a flag. Here's a bull flag formation. Let's go ahead and look at that. All right, so bull flags. I mean, that's what we call them, is bull and bear flags typically. So the bull flag is upright, and the bear flag is descending, of course. So you get measurements. That's the part of the chart patterns that I love. So you can get measurements from these. Like I said, the flag pattern is pretty obvious. I mean, it looks just like a flag. You get a breakout from a bull flag, you can expect a move the size of that flagpole. So that's what you're looking for. So if you see here, the minimum upside target out of this flag formation was way up here. Obviously, we failed to get there. But when we came back down and had that rounded bottom, we did end up coming up right at that upside target. Just took a little bit longer. All right, so that is the bull flag. Let's see, a bear flag. Again, I only have so much time here, so same deal. There's the reverse of that flag. I took a measurement of the flagpole. This looks like it got a little bit mixed up just because of the time change on the pattern, but that's the basic bull flag or bear flag. Again, length of the flagpole. If you get the breakdown, that's how far you should expect price to move down. Looks like we came very close to making that target on that downside target. All right, head and shoulders, we'll look at that because that's the one everybody is always interested in. All right, so here's a head and shoulders pattern, and it just looks like a head with two shoulders, left shoulder, right shoulder. Now there's a lot of interesting information about volume patterns and how you do that, but I'm not going to get into that because we're already very short on time. So it looks like a head and it looks like shoulders, and it's this chart pattern. You should expect a breakdown below what the neckline is considered here. And then you can measure the pattern and add that to the bottom, and that's your target. Well, we didn't actually get to it, did we? But we did get quite a breakdown. So, you know, you even can see possibly a bear flag that was forming, but that didn't come to fruition. They don't always come to fruition, but they do give you kind of a basic idea of, you know, what to possibly expect based on that pattern. All right, we're going to look at volume real quick. I think we're almost there. All right. So here is the definition of volume. Of course, it's the action between two individuals. Somebody's selling and somebody's buying the share, and the number of shares or contracts that we trade in the day is the volume. So it really is a reflection of, you know, your not just financial involvement, but emotional involvement. How many people were just had to sell today? How many people just had to buy today? It tells you a lot about the psychology. And there's a couple of different indicators. I typically use the on balance volume, but there are also various others. And again, you can find these in Chart School. And let's just go to, let's look at the SPY. So this is the OBV, and basically it's just a measurement of volume every day. If you look at the amount of volume, and if it's a down day, you subtract it from the current value, current reading. If it's an up day, the amount of that volume you add to yesterday's reading. All right. We've got one more I'm going to cover here, and that is momentum. That is the analysis of price changes instead of levels. So you're actually looking at the differences in price, and from that you can calculate the speed or acceleration, the movement, the rate of descent. It's synonymous with a slope. It's a rate of change kind of indicator. These are leading versus lagging moving averages. Typically, you're going to see momentum indicators be a bit more leading than lagging, like moving averages are. All right, and there are a few different indicators out there for momentum. The MACD PPO, so this moving average, convergence, divergence, the price percentage. The PMO somehow got written over there. I don't know how that happened, a little bug, but the price, the PMO is also a momentum indicator, and that is a decision point one. So I'll just show you a quick chart, and then I'll give you the summary, and we'll move along. I think I will do at least another one and maybe build on some of these concepts a little bit more, because I know this is pretty fire hose, but hopefully it's giving the beginners out there an idea of kind of what we do and what we're looking at and why. So on the chart here with the SPY, you can see that we have our price patterns obviously up here. This is my momentum indicator. So when it's moving down, that's telling me price momentum and acceleration is moving down. If it starts rising, that means, of course, acceleration is moving up. Buy-sell signals are just determined by crossovers. An upside crossover is a buy, downside is a sell. So you can watch the rising bottoms and see if they match price bottoms. That's when you get into those divergences and convergences, but we're not going to talk about that today. That'll be my tease. We have to do that next time. All righty. So the only other one I didn't cover is the scooter. That's the StockCharts technical rank, and I like to have this on there. I recommend you go check out Chart School so you can see how it's calculated. I use it to determine whether there's internal strength or relative strength, because it does tell you by its what the score is, not only how much internal strength it has, but also where it lines up among its peers. So that's the other reason I use it. So let's take a summary. So I covered price bars and time frames, and again, I know I did this really fast. We looked at moving averages. We looked at how to draw a support or resistance line and trend lines. We looked at a few price patterns, and obviously there are plenty more out there. And then I showed you some of the basic indicators, moving averages, momentum. We also looked at volume. So that pretty much concludes my building blocks of technical analysis. Like I said, I hope it helped some of those beginners out there.